All right, we're recording. Here's the class broken into kind of three pieces. Here's all the material we saw before the first midterm, present value, balance sheets, things like that. Then since the second midterm, we saw all these topics, and then the exam is going to focus on this new material, the stuff we've seen in just the past month or so since the second midterm. With this review session, we're obviously going to need some stuff that we saw before the second midterm. I'm not going to emphasize that. I'm going to emphasize the new material, everything that we've seen since the second midterm. That's going to be the focus of the final. Some things are going to keep showing up. So we know that present value calculations keep showing up. Bonds and stocks keep showing up. The balance sheets, enterprise value, free cash flows, those things are the basics of those things. We keep seeing those every time we do a capital structure problem. Every time we do WACC, we're doing the balance sheets, right? Every time we do APV, we need to know what the free cash flows are. So the basics of these topics continue to show up. I'm just not going to test you on the finer details. Likewise, since the first midterm, but before the second midterm, we covered these topics. Well, what have we used a lot? We've used risk and return and CAPM. Every day we talk about the expected return on different assets. Right? If you want to use WACC, you need to know the discount rate on the equity. Well, that's typically we typically get that from CAPM. Likewise, with Modigliani and Miller, that's been our starting point for everything we've done since then. Modigliani and Miller gave us the foundation to think about the WACC, to think about delevering, relevering, APV, float equity, right? That was a starting point, and we've just kind of built on that since then. We haven't seen much real options, so that's not going to be a focus. We haven't seen much of this type of sensitivity or scenario analysis since then. That's not going to be the focus. Alternatives to NPV, again, we haven't done too much of that, or project evaluation, we haven't done too much of that since. So that's kind of a sense of which of this old material is going to keep carrying forward. It's going to be the stuff that we keep seeing every day. Okay. So here's all the topics we saw for the first midterm. Again, time value of money we need, applications to bonds and stocks we need NPV rule, probably not these other things so much. We definitely need the balance sheet. We need to know what the enterprise value is, right? It's the value of all the operations. Likewise, we need to know the basics of the free cash flow. How do we get the enterprise value? Well, you discount the free cash flows. Here's the free cash flows. Now, I'm not going to test you on the details of the free cash flows like we did on the first midterm, or like you had to work through in the case study. But you should know the basics here. Yeah, so I think those are the key points that keep showing up. Here's the formulas. We're going to be using these today. We're going to use the perpetuity formula. We're going to use an annuity formula today, right? These things we just use every class. We need to know how to value bonds. I'm not going to test you on like the finer details. What happens if you get 4 coupon payments per year and blah, blah, blah. Just know the basics here. This is the bond valuation for a bond with an annual coupon. So you're just getting 1 coupon per year. It's relatively straightforward. You value that as an annuity of coupons plus the principal amount. Okay. Likewise, we can simplify things by looking at just a 0 coupon bond. We'll do an example of that today. If you have a 0 coupon bond, you get rid of this annuity piece and you're just left with the principal payment. And then with stock valuation, we know that a common way to value stocks, a simple way to do it, is as a growing perpetuity. You think the dividends are going to grow at a constant rate over time, so you just use this growing perpetuity formula to value the stock. And here's all the details with free cash flows. You're not going to need to know all the details, but you should know the highlights. Right, here's the equation. For the most part, for the examples we'll do today, I'll either tell you what the free cash flow is, or I'll tell you kind of what the EBIT is, and then I'll say forget about depreciation, CapEx, and net working capital. Okay, so that clues you in. If we're simplifying things, we're getting rid of these pieces and just focusing on the EBIT. That's the only piece of free cash flows. And that's kind of what I mean going forward. Is we're not going to get into the details, but we'll emphasize the bigger picture here. Again, the free cash flows are from the operations. That's conceptually an important point. You discount all those free cash flows to get the enterprise value. Right? So you start to see how all of these things are kind of fitting together. We get some more kind of detailed issues down here if you're selling a project. Again, these are more the details, the accounting details. I'm not going to test on the details of net working capital or salvage value, things like that. But we should know the most important points. Right. Going on to stuff we saw since the first midterm, but before the second midterm, 3 and 4 we keep seeing all the time, so you need to know those. With CAPM, here's our formula. Right, this is the expected return on any investment I. Right, this we'll typically use this for common equity. If you see stuff trading on a stock market, you can estimate the CAPM. So that's generally what we'll do, but in principle, you can use the CAPM for any investment you'd like. Right, this could be debt, this could be equity, this could be an individual project, or anything that can be run through the CAPM. It says that the return is only a function of the systematic risk. Systematic risk is measured by beta. You multiply the risk by what we call the market risk premium. That's how much you get paid per unit of risk, and beta is the quantity of risk. You put those two things together to get how much you should get above the risk-free rate because you're taking risk. Now we spent a lot of time on Modigliani-Miller. Even this last lecture I posted today kind of started here with the M&M assumptions. So we make some strong assumptions here, and the conclusion is finance is irrelevant. Right? Capital structure doesn't matter. The value of the company doesn't change. What we've done since then is we start to kind of play around with these assumptions. We take some out and see what happens to our conclusion. So what happens if we get rid of the no tax assumption? We know that debt gets a tax preference relative to equity. So if we account for that real life setting, then M&M switches. The conclusion changes. Instead of capital structure being irrelevant, we saw that you want to take on a lot of debt to get all the tax shields from debt. What we talked about last week and what I posted today shows some countervailing force. Right? If there's a cost of bankruptcy, then you don't want to take on an infinite amount of debt. You want to take on some debts until the cost of bankruptcy start to outweigh the value of the tax shields, right? And so you get these forces kind of pushing against each other, and that's what determines the value of financing. We also saw with M&M that debt makes equity more risky. Debt is a fixed cost. You have to pay the debt holders first. Equity is the residual claimant. They get whatever's left. So in good times, there's going to be a lot left over for equity. In bad times, there's not going to be anything left over for equity holders. So more debt is going to make the equity more systematically risky. We've talked about this idea a lot with delevering and relevering, so we're going to continue to see this today. Okay. And then we started to talk about tax shields. Interest expenses tax deductible, equity is not, so that pushes us to take more debt, as I previously mentioned. We saw some new equations right at the end, right before the second midterm. We saw these equations. These highlight Modigliani-Miller number 2. We just started with the balance sheet identity. Assets are equal to debt plus equity. Then we rewrote things in terms of returns. So the returns on the assets get paid as returns to debt holders and returns to equity holders. And they get kind of weighted, right? The total return of assets goes to debt and equity kind of in proportion to how much of the company they own. We did a little bit of algebra to see kind of in writing M&M proposition number 2. The discount rate on equity is the discount rate on the assets plus this capital structure piece. You take on more debts, equity gets riskier. And then we kind of started right at the end of the last segment, right at the beginning of this segment with the WACC. We're incorporating the tax shields into our discount rate now. We do that by multiplying the cost of debts by 1 minus t. So this gives us the after-tax cost of debt. We're pushing the discount rate down, and in doing so, we're going to lift up the valuations. Right? If you lower the discount rates, the value of future cash flows is going to go up. How much is the valuation going to go up? It's going to go up by the amount of the tax shields. It's going to go up by the value of those tax shields. Okay. That segues in between what we saw before the second midterm and after the second midterm. Here's all the things we hit in the last month or so, month and a half. We started with the weighted average cost of capital. We'll talk about this in detail. We were left a little bit unsatisfied with WACC because it has certain assumptions. Right, so it's the assumptions here, right? The project has to look like it's like the firm. It has to look like the assets of the firm. It has to be financed the same way as the rest of the company. And you need to have a stable capital structure. So these are pretty limiting assumptions for the weighted average cost of capital. We needed some other methods to try to get around those limitations. So for example, in the case study, you did some delevering and relevering. That was the focus of the Sterling case. The reason you had to do that is because the unit that you were acquiring looked different than the rest of the firm. And so you couldn't use the Sterling's WACC. You had to use a specific discount rate for the unit that you were acquiring. In order to do that, you had to kind of delever comparable companies and then relever to Sterling's capital structure. Okay, that's kind of big picture what we were doing there. But then we're still a little bit unsatisfied because if the capital structure is changing a lot, then the WACC is going to be a big mess. Right, this delevering and relevering process is not easy to do, and so you don't want to be doing this all the time. So APV is our second method. APV is the most flexible way to account for financing effects. It operates very differently than the WACC. It's a little bit more steps to do an APV problem, but those extra steps are what give you the extra flexibility. And we'll talk about flow to equity as well. After this, most rigorous, most careful valuation, the financing effects lecture, then we turn to something much more ad hoc, multiples. So with multiple valuation, you're just tying a market value to an accounting number. Just one accounting number is going to give you what you think that the market value is worth. So it's a kind of very rough approximation of valuation, but it's used a lot, and we'll talk about the pros and cons of that. We turn to VC valuation next. So VCs will often use multiples. It's hard to pin down a very precise number for a startup, so they use some kind of multiple to get a sense of the valuation. And then we talked about differences between the VC method and what we've done above. Namely, the first order difference is that VCs use very high hurdle rates. They may use a discount rate of like 50% or 100% to discount entrepreneurial companies. Why do they do that? They recognize that a lot of these startups are going to fail. And so what they do is they forecast a best case outcome, and then to recognize the fact that it's a best case and it's probably not going to happen, they ramp up the discount rate. So you discount a very high cash flow by a very high discount rate, and that kind of makes the result work out. Best case cash flow by a best case return, you get a present value. That means that we can compare the VC method with a more normal discount rate to figure out the probability of survival. So we'll do an example of that at the very end today. And then finally, the last topic is more conceptual. It's about bankruptcy trade-off theory and the pecking order theory. We talked about this last Monday. There's some examples here, but again, this is a much more conceptual topic. All right, so let's get into the WACC. We'll do a couple WACC examples. With every WACC problem, this is the goal. We want to get the free cash flows. We discount them by the WACC. That's going to give us both the value of the assets, the operations themselves, and the value of the tax shield. So you get everything together in one swift step. As a reminder, here's our WACC formula. We're lowering our discount rates here. We're using the after-tax cost of debt to push down the discount rate so that when we use it to discount the free cash flows, the valuation goes up by the amount of the tax shields. Okay. Now there's some assumptions that we have to know every time we use the WACC. The first is that the capital structure should be stable. If you just look at the formula and it's apparent, right? You need to know the ratio of debt and equity. What fraction of the company is in debt, what fraction is in equity. You need to know that. And if that changes over time, then the WACC is going to change and it's not going to be very helpful. This also precludes things like companies near bankruptcy. If a company's near bankruptcy, then these ratios could change pretty dramatically. And so again, the WACC is not going to be very appropriate. We also saw that the yield to maturity is typically what we'll use for the cost of debt. But again, if you're near bankruptcy, we know from way back in the second week of class, if you're close to bankruptcy, then the yield to maturity is going to be much higher than what you expect to earn on the debt. The yield to maturity is the return you get if there's no default. But what we want is the expected return. If there's a probability of default, then the yield to maturity is not going to be the expected return, right? We remember that. So it's going to be just very hard to even calculate a WACC if you're near bankruptcy. The other assumptions, which again we use the case study to alleviate these, but the project must look like the rest of the company. So typically with the WACC, you'll have one WACC for the entire company. You only have common equity for the company. You only have one RE for the entire company. We have one RD for the entire company. So if the project does not look like the rest of the company, then the company's WACC is not going to be appropriate for an individual project. Okay. And we said that there's two sides to that, right? Think about the balance sheet again. There's assets and there's financing. So in order to use the WACC, the assets of the project have to look like the rest of the company, but also the financing of the projects have to look like the rest of the company. So let's do an example, make sure that we're okay on the mechanics. Here's a balance sheet. I'm going to copy this onto the whiteboard so that we can have it. These are market values for an electric company. We want to find the weighted average cost of capital for this company. Okay, so we have to walk through this. We're given a tax rate of 30%. Then we're given some information on the debt. We're given some information on the preferred. And we're giving some information on the common stock. So for this company, not only do you have debt and equity, but you also have preferred equity. So you've got three sources of financing. Every source of financing shows up in the WACC. Just tack on an extra term for preferred equity. For a problem like this, maybe part A would be calculate debt over value. You calculate all of these ratios, right? What's D over V, P over V, E over V, right? Figure that out. That could be part A. And part B could be, well, what's the cost of debts? What's the cost of preferred is part C, and then E, V, R, E, say. So let's start with debt. Recall, and this is one of the more subtle points of the WACC, when we use debt, we really use net debt. Okay, so that's going to be the total debt minus the excess cash. Right, cash is always a pain to deal with. You're always taking it out, trying to avoid it. Real quick, what's the idea here? We've got assets on the left. We've got financing on the right. With the WACC, we're going to discount the free cash flows by the WACC. Now, what's generating the free cash flows? Well, the free cash flows are coming from the enterprise value. And you have to kind of pull that back from way back before the first midterm. The free cash flows are being generated by the operations. The value of all of that is the enterprise value. We want to discount the free cash flows, which are coming from here. The excess cash is not part of that. Right? So we don't want to be discounting something that's contaminated by cash. We want to get at this EV. So what we're going to do is we're just going to subtract the excess cash from both sides. That means that the weighted return of these three things is going to give us the return on the operations. If we leave the cash on this side, on the left, then the weighted average return of debt, preferred, and common, D plus P plus E, the weighted average return of that is going to be the weighted average return of EV plus cash. And we don't want to mix those things up. Okay, that was the kind of big picture idea. There's returns from both of these assets. There's returns on all this financing. We're only interested in the appropriate return for EV. That's what we want. So to hone in on that, we move everything to the right-hand side of the balance sheet. And we take the weighted average return of this stuff to get the return for the EV. Okay, so that's all kind of a reminder of a more subtle point. So what debt are we going to use for this problem? It's going to be the $150 in debt on the balance sheet minus the $100 in cash. So that's 50. The preferred is going to be 300, and the common equity is going to be the 650. Put all that together, we're going to get the total value, V, the denominator. It's going to be the value of debt, which is 50, plus the 300 preferred, plus the 650 in equity, so that's 1,000. Maybe part B would be find RD then. Okay, we got V, and we got each piece of these weights. So the last thing we need to do is get the actual discount rates. Where are we? We've got 50 over 1,000 times RD. We have a tax rate of 30% that's given. We have 300 in preferred out of the 1,000. We need to figure out RP. And we have 650 out of the 1,000. We need to figure out RE. And so we figured out the ratios. We need to get the returns now. We have information on the debt. We know that the debt consists of 0 coupon bonds, each maturing in 10 years with a face value of 1,000 and currently trading at 850. Okay. So again, this is about the simplest bond you can think of. You don't need to know all the details, but you need to be able to figure out the yield to maturity, right? You need to be able to infer RD. We know the price of the bond is 850, and we know that the bond only gives you one cash flow in 10 years. So we put these two things together to infer the discount rate. Okay, this is just our present value calculation. We know the present value is 850. That's what investors are willing to pay for this bond. The only cash flow is $1,000, and that happens 10 years from today. So the yield to maturity is the thing that connects the price and the cash flows. We know the price, we know the cash flow, so the yield to maturity is the discount rate that puts those together. So we can solve for this. You can do a couple steps of algebra to do that, or you can review your bonds lecture and see that the yield to maturity for a 0 coupon bond is going to be F, the face value, divided by the value of the bond, B, raised to the 1 over 10 minus 1. For us, the yield to maturity is going to be the $1,000 divided by the 850 price. raise that by 1/10 and then subtract 1. It's going to give us about 1%. About 1.6%. Okay, so that's RD, 1.6. Just kind of moving along the WACC formula. Okay. Then maybe part C is going to be to find the return on preferred. So we have to remember what is preferred and how do we get the return there. We have to remember one institutional feature about preferred equity. Preferred equity is just a perpetuity. You get a constant dividend every period forever. So this preferred equity is currently worth $10. It's trading at $10, and each share is paying a dividend of 75 cents per year. So the price of preferred equal to the dividend that you're getting. Dividend per share of preferred discounted by the rate, RP. It's just a perpetuity formula, but we're putting new names on stuff. This is the stock price for a share of preferred, this is the dividend, and that's the discount rate. So the equity is trading at $10. You're getting 75 cents in dividends. We just don't know RP, but we can solve for RP to be 7.5%. We call this the dividend yield because it's the dividend divided by the price. All right, so we're moving along. We got RP of 7.5. Last thing we need is RE. What's the discount rate on the common equity? Okay, that could be part D of a problem. The go-to approach here is going to be the CAPM. If you see what the stock price is doing, you see how it's correlated with the overall market, you can use that to estimate the return on the equity. We're given a lot of CAPM-like information in this last point. We have a beta of 2 for the common stock, we have a risk-free rate of 1, and we have a market risk premium of 2. So we're just going to put all that into the CAPM. Give us a discount rate of 13% for the common equity. All right, so that gives us every piece that we need in the WACC formula. Just run all this into your calculator to get about 10.76%. And that could be part E, say, of a problem. Put it all together to get the WACC. And then if I wanted to be really tough, make it a very long problem, I'm not going to make it this long on the exam, but suppose I wanted to, we can ask the next question. Okay. Essentially, what do you do with this? Right? Why did we do all this work to calculate the WACC? What's the point? Remember that the goal is to discount the free cash flows by the WACC, and that gives us the enterprise value. That gives us the value of the operations and the financing effects from those projects. That's what part F could be asking for here. This company is expecting to get a constant EBIT every period forever. Okay, so it's a perpetuity of EBIT in 1 year from today. There's no depreciation, no capex, no changes in net working capital. So all of this is a hint that we're going to keep the free cash flows very simple. You just have this EBIT. For this example, we just have EBIT and we get nothing else. No depreciation, no capex, no changes in net working capital. So the only free cash flow here is the EBIT. We're asked to find the EBIT, right? That's the question. Find the EBIT for this company. Now, in principle, we should be able to do this because you know how these things are connected, right? This is a big picture question. How are all these things connected? You discount the free cash flows by the WACC to get the enterprise value. Well, we know what the WACC is. That was 10.76. We know the enterprise value. That was from the balance sheet. We were given that of 1,000. So if we know those two things, we can solve for the free cash flows. Because we know that the free cash flows are a perpetuity. We know that the free cash flows must be 107.6 in order for all this to fit together. And if we know that the free cash flows are just the EBIT times 1 minus T, we know that that's got to be 107.6. Got to be the EBIT times 1 minus our tax rate of 30%. So that can let us solve for the EBIT. Works out to about 154. Okay. So again, this is much longer than anything I would put on this test because it's maybe I could do this on a paper exam, but definitely not with it being online with a an F part thing. But the point is you want to see how everything fits together, and if you can see how all these pieces fit together, then I think you're in pretty good shape. Any questions on that? Okay, and then we'll do some delevering and relevering, and we'll see that delevering and relevering feeds very nicely into WACC. We saw this with the case study. Again, you had to calculate a particular discount rate for the unit that you're acquiring. That discount rate is going to be different than Sterling's company-wide WACC because Sterling's assets were different and their financing may be different than the acquisition. So you had to be very careful in the delevering and relevering process for your particular acquisition. The case study was doing the second question. How can we compare different companies with different capital structures? You looked at comparable companies that had the same assets as the unit you were acquiring, but they had different capital structures than Sterling. And so you had to do this delevering and relevering process to get the appropriate discount rate for the acquisition. The other way to do it, or the other way that this delevering and relevering can show up, is with an example we'll do today. Think about the firm changing its capital structure. It used to have one capital structure, now it's going to have another capital structure. Well, you need to adjust the discount rates for that process. It's the same firm now, just different capital structure. In the case, it was different companies with different capital structures, and you had to do the same steps. The steps are always going to be the same with delevering and relevering here. Hopefully this looks familiar. The first thing you want to do is get rid of any capital structure effect and just get the discount rate on the operations. That's RU, the return on the unlevered project. So RU is going to be the pre-tax WACC, debt over value times RD, plus equity over value times RE. So WACC formula, just get rid of that tax piece, right? We used to have 1 minus T here for the WACC, but we're not going to do that anymore when we're delevering. Second piece is to relever to the new capital structure. For our purposes, we're going to use a relatively simple relevering formula. Relevering formulas can get ugly. For our purposes, we're going to use a simple one. We actually saw this at the right before the second midterm. This is Modigliani-Miller. The discount rate on the equity is the discount rate on the assets, RU, plus a Modigliani-Miller 2 term. You take on more debt, the equity gets more risky. That's all summarized in this slide. Every problem has these same 2 steps. You delever, and then you relever to the desired capital structure. I worked through the derivation here. One note to remember is that if we want to use these formulas, something has to be true about the capital structure going forward. Okay, so this is a finer point that's worth remembering. Whenever we do this, we're going to have companies that have a stable debt to equity ratio. That means that when the company grows, you're going to take on more debt. When the company shrinks, you're going to take on less debt. Okay, and I worked through the algebra on the slide here to show why that works. Our general relevering formula is this big ugly thing. The way that we can get rid of the last piece here, the hardest piece to work with is this last piece. The way we get rid of that is to have the discount rate on the tax shields equal to the discount rate on the assets. That's driven by this assumption. The debt to equity must be stable going forward. That means that the tax shields grow and shrink with the assets. Here's the punchline of that. If debt to equity is stable, then that means when the assets do well, you get the following chain of causation. The assets do well, that means debt's got to go up to keep the ratio the same. When debt goes up, we know that tax shields go up. So that means that the risk of the tax shields looks like the risk of the asset. And that's what gets rid of this kind of ugly piece here. Okay, all right, so let's dive into an example. These are the steps. Every problem we see are gonna follow these steps. So let's make sure we can execute. You're working at a firm. You're trying to value a project. The issue is the company has changed their capital structure, and so you need to go through this process of making sure you know what your correct discount rate is going forward. So they're going to issue some debt to pay off equity. The new debt to equity ratio is going to be permanent. Okay, so that's not just a throwaway line, that's giving you the go ahead. You can use these equations because the debt to equity is going to be permanent. You need to figure out what your new discount rate is going to be when you evaluate projects. You have a tax rate of 20%. Part A, say, before the change, you know what you were doing. You know what the discount rates look like before the company changed their capital structure. You're going to use that information to figure out what your new capital structure or what your new discount rate should be. Before the change, the firm had 50% debt, 50% equity. We had a cost of debt of 5% and a cost of equity of 17%. So what is the WACC? Right, so this isn't anything new. We saw the WACC before. That's just debt over value. So if it's half debt, then the debt over value is going to be a half. So it's half debt. The debt used to have a discount rate of 5%, and the tax rate is 20%. If it's half debt, then it's half equity, so E over V is 1 over 2, and the return on the equity used to be 17%. Run this through your calculator to get about 10.5% for the old WACC. Part B is asking to find RU. This is the return on the assets. Forget about any capital structure effect, just the return on the assets. Well, we know that RU is going to be given by these by this first equation. It's the pre-tax WACC. It looks like the WACC, but we're just going to leave off that 1 minus t term. Everything looked the same as above. We just drop the 1 minus t. That gives us 11%. Okay. Moving through the process, we're going to relever. Right? If you delever to get the return on the assets, then you're going to relever to a new capital structure. We had a discount rate on equity of 17%, but that was under the old capital structure. So we need to find the new discount rate of equity after the change. So here's our relevering formula, but I want to emphasize that you have to use the new values. You have to use the new value of debt over equity. You have to use the new discount rate on the debt. All those old stuff, those aren't useful anymore because we changed our capital structure. The thing that doesn't change is RU. Right? That's the return on the assets. So that is not affected by capital structure. That's just the required return given the risk of the operations. That doesn't change. Everything else is going to change, but not RU. After the change, the company's going to have 80% debt and 20% equity. So what's debt over equity going to be? It's going to be 80 divided by 20. RU is still 11. What's the cost of debt going to be? It's going to go to 7%. It used to be 5, but now it's going to be 7 because you're taking on a lot more debt. So the discount rate goes up. That into your computer and you'll get a 27% discount rate for the equity. Okay. And finally, Part D is asking you to find your new WACC, right? That's what you're after. When you're this manager, you want to know, what do I use for my new projects? you need to have a WACC. So it was a bit of an involved process to get the new discount rate on equity. You needed that to calculate your new WACC. And again, we're going to use all the new values now. What's the new debt to value going to be after the change? Well, it's going to be 80% debt. So that's going to be 0.8 is the debt to value. What's the new discount rate on the debt? It's going to be 7%. It used to be 5, but now it's 7. The tax rates stay the same. It's like the only thing that doesn't change here. Equity over value used to be 50%, but now it's going to be 20%. Discount rate on the equity used to be 17%, but now it's going to be 27%. You got lots of rates floating around. You have to be very careful and keep track of new versus old. Or in the case study, you had to keep track of competitor versus you. That gives us a weighted average cost of capital of 9.88%. So that's what you would use for new projects. Conceptually, again, we want to think about what's kind of going on in this process. The WACC dropped. You took on a lot more debt. It used to be 50% debt, 50% equity. Now it's 80% debt. So the WACC dropped from 10.5% to 9.8%. That makes sense because when you take on more debt, you're getting more tax shields. So bad projects are going to look okay now, because at least you'll get the tax shields out of it. Another way to say this is what is WACC doing? You're pushing the discount rate down to account for tax shields. Well, if you're getting more tax shields, then you have to push the discount rate down more to account for the greater value of those tax shields. The new valuation is going to incorporate that higher valuation because now we got a lower discount rate. All right, so you see WACC is pretty important. So you see how it fits in with delevering and relevering kind of naturally. Sure. Any questions on the delevering and relevering? Then we'll move on to APV. Just like every delevering and relevering problem has these two steps, every WACC problem has this basic structure. APV is going to have certain patterns as well. First step in most APV problems is going to be to discount the free cash flows. Those are generated by the operations. So you discount them by the return on the operations, RU. This gives you the value of the unlevered project. U for unlevered. Notice that these things don't change with your capital structure, right? It's the value of the unlevered thing. If you take on more debts, you're still calculating the value of the project without any leverage. So this does not change no matter what you do with your capital structure. That's going to be nice. With APV, we really like APV when the capital structure is changing a lot. WACC is going to be a mess because you have to do all the delevering and relevering when capital structure changes. But with APV, notice here, that first step doesn't change at all. Okay, it's going to be the same no matter what happens to your capital structure. The second step for APV is to discount the tax shields themselves by an appropriate discount rate. We want to get the present value of all of those tax shields. Now, this RITS is a little bit of a weird discount rate. We have to think about how risky are the. If we can think about how risky the tax shields are, then we can pin down RITS. But it's a little bit of a weird concept to think about the risk embedded in tax shields. It's not like an asset by itself. It's not not equity or anything. It's the tax shields that the project is generating. We've talked about two possibilities here. This is the world with delevering and relevering that we just recently discussed up here. If debt to equity is stable, then we saw that we get the following chain of causation. When the assets change in value, then the debt has to change in value, which means that the tax shields are going to change in value. So how risky are all those future tax shields? Well, they're as risky as the assets. When the assets move, it sets in place this chain that also changes the value of the tax shields. That means that the risk of the tax shields is the same as RU. That's not always going to be the case, though, and APV is really going to shine when that's not the case. Remember, this debt over equity being constant, that's really the world of WACC. Right? APV is great when capital structure is changing. If this capital structure is staying the same, well, then we've got other tools that we can use. So APV is really going to shine here. If there's not a connection between the assets and debt, then we just have the following chain of causation. All we care about is the debt. The debt's what drives the tax shields. So the risk of the tax shields is going to be the risk of the debt. As long as you don't default on the debt, you'll get the tax shields, but there's no kind of connection between the assets now. And then the last part of any APV problem, it's pretty kind of intuitive, is you're going to add the results from 1 and 2 together. The value of the levered project is going to be the value of the project with no leverage plus the value of the tax shields. You just add up 1 and 2 together to get the total value of the levered project. All right, so let's do a couple of examples. That's kind of big picture idea. We'll make sure we're okay on the mechanics. If you're evaluating an investment, it's going to generate free cash flows of $1,000 per year for 15 years, with the first cash flow being received in a year. Right, so this is an annuity, right? We need to remember how to think about annuities. I just described an annuity to you. The project costs $5,000. Your tax rate is 35%, and the discount rate on the assets is 20%. So what is the value of the project if it is not financed with debt? In other words, what is VU, the value of the unlevered project? Well, we're going to discount all those free cash flows by RU. What do the free cash flows look like? Well, you get this $5,000 cost at time 0, and then you get this annuity from years 1 to 15. So we have to discount that annuity using the annuity formula. That initial cash flow is $5,000. And then you're going to get an annuity of $1,000 with a discount rate of 20%. That occurs for 15 years. That gives us a minus 324. So just looking at the operations by themselves, it's a bad deal. Now part B is asking, if you're going to pay for this project, you're going to use some debt. In particular, you're going to issue $900 in debt at an interest rate of 5% and a cost of debt of 5%. And then you're going to pay that debt off over time. You're going to pay off $300 in principal in each of the first 3 years of the project. And this is a hint. You should use APV here because capital structure is changing. Right? You're paying off your debt, so that's perfect for APV. Part B is asking you to find the tax shields for those 3 years. And Part C is asking you to find the present value of all the tax shields. Okay, so Part B and C together are breaking up step 2 in APV. Right? First, you got to find the tax shields. Then you have to discount them by RITS to get VITS. So Part B is just asking you to find the tax shields. I'm going to lay this out with a table just to see how things are changing. So what's going on to the debt? You're going to issue $900 today to finance this project. Right? You have to pay this $5,000 somehow. You're going to pay some of it with debt, $900 worth of debt. The problem says that you're going to pay off the principal. You're going to pay off $300 in principal for the next 3 years. So at time 1, you pay off $300, so you're left with $600 in debt. Time 2, you're left with $300. And then by time 3, you've paid off the debt. You've got 0 left from time 3 on. Next thing we have to figure out is the tax shields. So how much are we saving in taxes because of this debt? Well, at time 0, there's no savings, right? It takes time to accrue these interest expenses. So today, you don't save any money because you just got the debt. You can't get an interest expense the day you take out the debt. So nothing happens today. It starts in year 1. Mind you, what is the tax shield? It's going to be the debt times the interest rate times the tax rate. So at time 1, how much debt did we have during that year? We had $900 in debt during that first year. We had an interest rate of 5% and a tax rate of 35%. During the first year, we saved 15.75 in taxes. We'll do the same thing for years 2 and years 3. The only thing that changes is the level of debt. We paid off some debt at time 1. So how much debt do we have during year 2, we only have the $600 in debt now. That's still charging us an interest rate of 5%, and we still have a tax rate of 35%. So we're left with 10.5 in tax shields at time 2. And then finally, we'll do it for time 3 as well. But now we only have $300 during the year. So we're going to save less in taxes. We're going to save 5.25 in taxes. And then year 4, we have no debts, so we get no tax shields. So part C is asking us to value these things. We need to discount the tax shields by RITS. We figured out what the tax shields are. We just need to figure out what is the discount rate for the tax shields. So we go up to our above deliberations here in step 2. This RITS we said was weird. It could be a couple different things. If the debt is tied to the assets, then RITS is going to be RU. Otherwise, the discount rate on the tax shields is going to be RD. So in our example here, is there any connection between the assets and the debt? Well, no. You're paying off the debt over time. You're paying it off in 3 years. You know, whatever's happening to the assets, there's no connection between what's going on with the assets and your plan to pay off this debt. The assets are paying out over 15 years, and you're going to stick to this plan of paying off the debt in 3 years. Right? So you've got lots of asset cash flows going on that are not connected to the debt in any way. So that means we're in part B, we're in 2B. There's no connection between the assets and the debt. Then as long as you pay off the debt, you get the tax shields. So the risk is going to be relatively low on the tax shields. It's going to be equal to RD, which is given at 5%. All those tax shields. We have 3 cash flows. We have a discount rate. We have 15.75 divided by 1.05 plus 10.5 divided by 1.05 squared plus 5.25 divided by 1.05 cubed. You put all that into your calculator and you'll get 29.06, just glancing ahead. That brings us to the conclusion. We know the value of the operations, the value of the tax shields. We're going to put them together to get the total value of the levered company. So the value of the operations was this negative 324. That was from part A. And we know the value of the tax shields is the 2906 from part C. So we're still down about minus 296 in NPV terms. So what could the company try to do to make this a good deal? We know that the operations are bad, right? Minus 324 NPV. There's not much you can do about that. But if you're the CFO, maybe you try to play with the second number. Maybe if you can take enough debt, you can drive the value of the tax shields above 324, and that would turn this into a good project. Right now, you don't want to take the project because the total value is negative 300 basically. But right now, you're also paying off your debt very quickly, and you don't have very much debt. You're only financing $900 in debt out of the 5,000, and you're paying it off very quick. So who knows? Maybe if you play around with your financing, you could get enough interest expense, enough interest tax shields that could drive this 290. This is $29 above 320, and then this would be a good project. As of now, it's not a good project, but potentially you could drive up the value of those tax shields. Okay, any questions on this APV problem? I think that this is a good example of where APV really shines. Your capital structures, and so you can use APV without too much difficulty. I mean, you have to keep track of the tax shields every period. That's a little bit annoying, but it's a lot less annoying to do this than to do the delevering and relevering every period, which is what you would have to do with the WACC or the float equity method. Let's do a second APV example. Yeah, so Alshon, thanks. That's exactly what we're going to do for the second example. We're going to have a connection between debt and assets. We'll do an APV problem where there is that connection now. Okay, so that's APV example 2. So we're still going to follow the same steps. But now we're going to see this connection where, oops, I'm not going to do that. We're going to see this connection where assets and debt are tied together. That's going to affect the discount rate on the tax shields. In this example, this project is going to generate $500 in free cash flows every year, starting in a year. So again, we get a perpetuity. The project costs $1,800, and the discount rate on the assets is 11%. So what is the value of the unlevered project? Again, taking our APV steps, again, we're asking for this VU. What is VU? You just discount free cash flows by RU. We're given all of that in the kind of prologue there. In this case, the free cash flows aren't an annuity, they're a perpetuity. You get a cash flow today, that $1,800 cost, but then you get a perpetuity of cash flows. We can value those using the perpetuity formula. That's the second piece. Here's the cost, and then you get 500 in perpetuity. That gives you 2745. Now we're going to move on to the value of the tax shields. So your company has this target capital structure that you want to keep. So in particular, you're going to raise $1,000 to take the project with an interest rate and cost of debt of 4%. And you're always going to keep this target capital structure over the life of the project so that your debt to equity ratio stays constant. Debt to equity being constant, that means we have this following chain. The assets grow, that means your debt's going to grow, that means your tax shields are going to grow. Therefore, the risk of the tax shields is going to be RU, which is given at 11%. Okay, that's different from the first APV example we did. First APV example, we had the risk of the tax shields is the risk of debt, but now we have the risk of the tax shields is the risk of the assets, all because of this one statement. we still need to discount the tax shield. So we know the discount rate we're going to use is 11%, but we need to know what the tax shields are. And the interest tax shields are going to be debt times the interest rate times the tax rate. You're going to keep $1,000 in debt in perpetuity. That's your plan. Notice that the free cash flows are a perpetuity. So if you're going to keep debt to equity constant, you need your debt to be a perpetuity too. That means that your tax shields you expect to be a perpetuity. How much are you going to get in tax shields? You have $1,000 in debt, you have the interest rate of 4%, and you have the tax rate of 30%. You're going to get $12 in tax shields every year forever. Again, as it says, that's you're going to keep that same level of debt. That's going to allow us to calculate the value of these tax shields. You're getting $12 every period forever, so the total value is going to be $109. Okay. But as Alishan said, this is exactly the difference between APV example 1 and APV example 2. It's just how risky are the tax shields. That's the main conceptual difference here. Part C is going to be the same. The value of the levered project is going to be the value of the unlevered project plus the value of the tax shields. So we had 2745 from part A plus the 109 from part B. You get 2854 for the total value. Any questions on APV? As you can see, we've done a lot with WACC, we've done a lot with APV. These are things that kind of always show up. Okay, let's move along to flow to equity. Flow to equity, we don't focus on too much. It's not quite as important as the others, but we should understand the basic steps. As the name suggests, you're focusing entirely on equity. So you need to get the cash flow going to the equity holders, kind of what's available to the equity holders. You discount that by the appropriate rates for the equity, and that gives you the value of the equity. We had to introduce this new thing called the free cash flow to equity, FCFE. Again, that's how much cash you could use to pay the equity holders. How much cash could you pay the equity holders? Well, you start with the free cash flows. That's how much the operations generate. So that's your kind of baseline. But then you can't pay the equity holders out of interest. This interest expense, that's going to the bank. And so that's cash that they can't get. So you subtract that from the, you subtract the after-tax interest expense, because when you pay the bank $1, we know that there's tax deductibility of these interest expenses. And so the true cost of the equity holders isn't that $1, it's 1 minus $t, You get T cents back for every dollar that you pay the bank. What else affects the equity holders is any new debt. If you take out a big loan, you could use that to pay the equity holders. So we call that new debt issuance. Or if you, well, let's call it net debt issuance, because you could pay off your debt. If you pay off your debt, then that's obviously cash that equity holders can't touch anymore, right? You sent it to the bank, equity holders can't use that. Okay, so this is our new variable. We're going to discount that by the appropriate rate on the equity to get the value of the equity. We're generally going to have kind of stylized problems here. So again, we're going to have a annuity or a perpetuity, excuse me. The EBIT is going to be $750 in perpetuity. So you can see where I'm going. We're going to get a free cash flow to equity perpetuity. Then we'll be able to value the equity as a perpetuity. Okay, so that EBIT is going to continue forever. We're going to assume that the company doesn't have any CapEx, no working capital, no depreciation. Okay, so here you have to remember a little bit about free cash flows. You have to remember that free cash flows are EBIT times 1 minus T, plus depreciation, minus CapEx, minus increase in net working capital. But what I've just done is told you to ignore these last pieces. Right? There's no depreciation, no CapEx, no net working capital. So we can get this free cash flow piece from the free cash flow to equity formula. It's just going to be the 750 times 1 minus T, which is 25%. And add 0 depreciation, subtract 0 CapEx, subtract 0 increases in net working capital. We get 562 in free cash flows. Okay, so free cash flows are perpetuity. Next, we have to deal with these other pieces in the free cash flow to equity formula. We know about their debt in this third bullet point. The company issued 30-year debt. It has an interest expense of $300 every year. Right, so hey, that's what we're looking for here, right? Interest expense $300, and it's saying that that's occurring every year. So it's a perpetuity, just like everything else in this example is going to be a perpetuity. You expect those interest payments to stay constant forever. As the old debt matures, you simply issue new debts in the same amount and at the same interest rate. Okay, so what is this bullet point telling us? Well, it's telling us very directly what the interest expense is. It's going to be $300 in perpetuity. It's also telling us what's going on with our debt issuance. Okay, so that's going to be 0 in perpetuity. What happens is you're paying off all the old debt using new debt. So whatever debt I have today, I'm going to keep that level going forward. So I'm never taking out kind of on net a new loan. I'm never paying off the old loans. It's just always constant. So the net debt issuance is going to be 0. So now we have everything we need for this free cash flow to equity formula. We have the free cash flows 562 in perpetuity. Now the interest expense is 300 in perpetuity, and we know that the net debt issuance is 0 in perpetuity. So we'll have 337.50 in our free cash flow to equity, and everything's in perpetuity. All right. So the last thing we need is we need a discount rate. If we can get a discount rate for the equity, then we can discount the free cash flows to equity and be done. So this third bullet point is just telling us we don't know much about the debts. We don't know how risky it is. We don't know how risky the assets are, but we do see a lot about the equity. So, okay, ding, 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 we're going to get this RE. We know that the company has a beta of 2. And we have all this other CAPM information. We know the risk-free rate is 5, the market risk premium is 8. So we're going to put all that together to get RE. Risk-free rate of 5 plus a beta of 2 times market risk premium of 8. It's going to give us a 21% discount rate on the equity. We have the cash flow to equity now. We have the discount rate on the equity. We'll put those two things together to get the value of the equity. It's going to be about 1607. All right, any questions on that? Okay. All right, so we got a few minutes left. Talk about multiples. Multiples are kind of much simpler. So I'm not going to, we'll do one example with venture capital that incorporates multiples. But the basic idea is you have some accounting number and you use that one number to infer a market value. Okay, so you can think about this in real estate. People talk about price per square foot, right? The accounting number is how many square feet are in a house or in an apartment. And then the market value is the price of the house or the monthly rent in the apartment. Right? Everything gets tied to that one number, that number of square feet. You can do that with any number. You can do that with, in the case study, for example, you use this exit multiple of free cash flows, right? 9 times free cash flows. That was your terminal value. The accounting number there would be the free cash flow, and then you multiply that by 9 to get the market value. That's how much the company should be worth at exit, at whatever time 10 in the case. Okay. So the ingredients are always the same. You get some market data from a comparable company, and you have accounting data from your firm. You use the ratio of the market value to accounting data to figure out what your market value should be. Okay. Now the main difficulty is that, well, it's a little bit ad hoc, right? You're putting everything on just one number, and it's also going to be difficult to get true comparable companies. In your neighborhood, maybe you can find a home that's very similar to your home, but there's always going to be kind of hidden differences. With VCs, they use this a lot. What they typically use is an exit multiple. So you forecast what the company could be worth when you go public. Kind of best case scenario, everything goes well, you make a lot of money. How much is the company going to be worth then? You use some exit multiple there. So what are my sales going to be, say, in 10 years when I exit? You multiply that by some sale multiple to get the value of the company at exit. Okay. Now, when we do these VC forecasts, VCs typically forecast the cash flows in those best case outcomes, just like I talked through here. But there's a high probability of failure. So in order to offset that high probability of failure, VCs discount those best case cash flows by really high discount rates to get kind of a expected value of the company. That's going to be the key feature of VC that I want to talk about here, and we'll do an example of this. What we can do is we can figure out what that probability of survival is by comparing the valuation that the VC is using against a valuation with a more normal discount rate. Okay, so you've got some exit value if the company succeeds. Let me write out the logic here. You can think through this very simple equation. Right? What's the expected value of a company? Well, it's going to be the probability if it succeeds times the value of it if it succeeds. Okay, that's going to be the expected value. What the VCs do is they forecast the cash flows, kind of assuming that it's going to succeed. And then they use a very high hurdle rate to get the expected value of the company. what we can do is we can value the company using a normal discount rate to basically assume that it's going to survive, and then back out this probability of success that's kind of embedded in the VC's valuation. Okay, so let's just do an example of that. It's easier to kind of see it in a simple example. So you're a venture capitalist, you're thinking about investing in some biotech company. If you invest in the company, you're hoping that it secures a patent. If it does, it's going to have an EBIT of $10 million in year 5. Then it's going to be bought by Pfizer. It's going to have a multiple of EV over EBIT of 8. Okay, so this is going to be the value of the company at time 5, right? It's going to be an exit multiple. That's the logic here. We're going to see what the EBIT's going to be at time 5. It's going to be 10 million. And then we have some multiple of 8. Companies are worth 8 times their EBIT. That's what this multiple is saying. So that means that the company's going to be worth $80 at time 5 when you exit. And this is the only cash flow for the company. From the venture capitalist perspective, the only time you can get money out of the company is at exit when you sell your stake. In this case, they're selling to a company, Pfizer. Okay. So VC valuations, it's nice that you just have the one cash flow to deal with. We're going to discount this cash flow. It occurs at time 5, so we need to get the present value of the company using a hurdle rate of 45%. And remember, 45% is kind of crazy high. You know, you're not going to get that from a reasonable kind of beta. So what's the present value? It's going to be the terminal value at time 5, discounted by the hurdle rate. That works out to about 14.8. When the VC is using this very high 45% discount rate, that's what they that's incorporating the probability that they get nothing. Right? They ramp up the discount rate to get a very high discount rate to include the probability that they'll get 0 actually. Okay. RP is asking, suppose that you need to put in $4 million today to pay some researchers to try to get this patent. Okay, so that's where the VC comes in. You're going to put in $4 million. How much does the VC require an ownership stake in exchange for this $4 million? All right, so what's the logic here? VC is putting in some investment amount. They have to get something back in return. So what they get back has to be equal to what they put in. They put in $4 million. That's got to equal their share of the company. They put in 4, that's got to equal the stake times the value of the company, which is 14.9. So their required ownership stake is going to be 4 divided by 14.9. Which works out to about 27%. Now, the last part is to try to hone in on the probability of success, right? We're going to get back to this equation. You look at companies with similar assets. and they have a discount rate on the assets of about 15%. Now you're a VC, so you know that you get paid fees, and you have to compensate your investors for the fees that you're going to take out. So you know that the required return on your investments is really 21%. How can you use that to figure out the implied probability of getting the patent, of surviving? This 21%, this does not include the high probability that things are going to fail, right? This is what they expect to earn. This is what they require. That 45%, that is not what anyone would expect. That's what you expect in the best case outcome. So what we're going to do is we're going to compare a 45% valuation versus the 21% valuation to figure out the probability that things are going to succeed. What's the present value of the company if it succeeds? Well, it's going to be worth 80 million. And we're going to use 1 plus this kind of reasonable discount rate, say a CAPM discount rate, say. That's going to give us a value of about 30.84. So this 30.84, that's the value of the company if it succeeds. Right? The present value if a success. That's not what you expect to happen. You expect it to be worth 14.9. That's the expected value of the company. So what we're going to do is we're going to put those together to get the probability that you get the patent. VC is not dumb, right? The VC knows that there's a high probability that things won't work. So that shows up in their expected value. Present value, if it's successful, is at 30.84. The expected value is the 14.9. So the ratio is going to give us the probability of success. Which works out to about 40%. Okay, so you can look at old exams, you'll see problems like this kind of recur. And then the last topic for this class is more conceptual. It's about bankruptcy. Right? The big idea here is that there are some costs of bankruptcy. You like tax shields when you take debt, but there's these costs that push you in the other direction. And we talked about it conceptually and did some examples last class, so I'm not going to do any more today. All right, so that's a whirlwind. I think we covered all the points. We did as much practice as we could stomach in these 90 minutes, 95 minutes. Thanks everyone for a great semester. It's been